Hello and welcome back to the Note. Well, today's big event, it turns out, was a non-event. The Fed published the minutes of its last meeting from last month on interest rate policy, and we learned basically that the governors had decided to make as clear as possible that they intended to raise rates next month, if at all possible, and they also wanted to say that they intended to signal when that rate rise happens that they think the path of rises thereafter is more important and that path of rises will be very slow. That, in other words, in the market jargon these days, is a dovish hike. Now you can see from this chart that we've shown you many times before, it shows you the implicit probability of a rate rise next month as derived from the Fed Funds Futures Market by Bloomberg. You can see that this had precisely no effect on the market. This is bang in line with expectations. A rise next month is seen as roughly a 2 in 3 shot. I think that might be somewhat of an understatement. Now that led to very calm markets across the world, generally a poor day for stock markets in Europe, a very good day for the US stock market, and a dovish hike given that markets now really are used to the idea that there'll be a hike next month. A dovish hike would be good for stock markets in the short term. I would, however, like to signal one element of concern. If we take a look at the price earnings multiple on the S&P 500, the single most important yardstick for measuring valuation, you can see it comes down sharply during the correction in August. But subsequently we had an earnings season where we discovered that earnings hadn't risen at all. In fact, they'd fallen slightly. And so the PE multiple has come pretty much all the way back to where it started. Now the idea of a correction is that markets get overvalued. They fall sharply to a new, more sensible valuation, and from that point they rise with rises in earnings. That's obviously not happened here. We still, frankly, are in need of a correction in the stock market. Bear this in mind as we approach the rate rise, likely in December and the end of the year.